Abercrombie Fitch is a globally recognized clothing brand with a good established reputation. However, the business is a lot more than just its Abercrombie clothing brand. It's a globally specialty retailer with a large portfolio of fashion labels such as Hollister, Gilly Fix, and of course Abercrombie Fitch. It operates over 750 stores worldwide and has massively expanded its digital presence in the last few years. With all this being said, the stock has fallen 63% from its all-time highs around 10 months ago, and it is trading at just a 6 price to earnings ratio today. So has this stock fallen out of fashion with investors? And if so, is it trading at a significant discount in the market today? But before taking a look at Abercrombie's fundamentals, I would like to see why the stock has fallen 63%. Firstly, Abercrombie did give a pretty pessimistic outlook in their Q4 for 2025, with a projected sales growth between 3 to 5% compared to their 16% growth in 2024. Now, their reasoning for this was due to the potential impacts of tariffs, with the CFO stating that our outlook includes US tariffs on China, Canada, and Mexico currently in effect. Now, the issue with this is the CFO stated this back before Trump announces global tariffs. Now, the reason this is so important is because, like all clothing brands, Abercrombie doesn't produce their clothes in the United States. Most of their clothes are produced in Bangladesh, which Trump has placed a 37% tariff rate on, or in places like India, which has received a 26% tariff rate. This will massively affect the cost of their clothes in the United States, which will result in less sales, or if they wish to keep the cost the same, it will eat into their margins. Going straight into their most recent result, which was Q4, we can see that for the year, revenue hit a new all-time high of $4.9 billion, which is a staggering 15.65% year-on-year growth. Now, this is way above their 5-year average of 12%, and with last year's year-on-year revenue growth showing a similar 15.49%, this does or may indicate that Abercrombie has been accelerating in revenue growth. While revenue has grown on average by 12%, cost of goods sold has only grown on average by 9.47%. Now, this does indicate that Abercrombie has been gradually becoming more profitable and has meant that gross profit, which was $3.2 billion for the year, has been growing quicker than revenue with a compounded annual growth rate of 13.8% over the past 5 years. Operating cash flow saw modest growth in the year 2024, with Abercrombie producing $710 million compared to $653 million in the year prior. This represents 8.74% growth year on year. Most importantly though, we can see that they produced $527 million for the year 2024 compared to $496 million in the year 2023, and is currently trading at a price to free cash flow of 7.5, well below the 5-year average of 10.61. Now, free cash flow growth of just 6.4% I believe is quite decent, especially with it trading at just a price to free cash flow of 7.5. And although their free cash flow can be quite jumpy, I believe that if Abercrombie can maintain at least a modest level of free cash flow growth, their price ratio could seem very cheap in the market today. I also think taking a look into EBITDA is quite important for a company like Abercrombie because it shows us what the core business is producing while taking out non-cash expenses such as depreciation and amortization. Now, as you can see here, Abercrombie produced $906 million in EBITDA for the year 2024 and $634 million in EBITDA for the year 2023. Now, this represents growth of 43% year on year, with an average growth rate for the past 5 years of 44% year on year. And this does include COVID, which you can see has a pretty big dip here, which is quite impressive. Now, to truly understand if these figures are as good as they seem, I think comparing it to one of its competitors in its industry, such as American Eagle Outfitters, would help us to see how it compares to other specialty realtors out there. Starting off, we can see here that over the past 5 years, Abercrombie has produced on average 12% revenue growth rate compared to Eagle Outfitters' 9%. Now, this is only a 3% difference, but over the course of 5 years, this can be quite drastic. Moving on to EBITDA, we can see that Abercrombie has outpaced Eagle Outfitters by about 5% over the past 5 years, and Eagle Outfitters has only produced 11% EBITDA last year on year, compared to Abercrombie's 40%. Taking a look at free cash flow, we can see that Abercrombie has grown its free cash flow by about 15% on average over the past 5 years compared to Eagle Outfitters, which has changed by 34% on average. Now, Eagle Outfitters has produced a lot more on average over the past 5 years. However, we can see that Eagle Outfitters' free cash flow did drop in 2024, although they are still trading at a higher price to free cash flow, which could suggest that it is slightly overvalued. Now, taking a look at Abercrombie's balance sheet, the first thing that stood out to me is that their cash position did decrease 16% year on year. However, they did put this to good use by using it to go completely debt free, which does allow them to accumulate free cash flow a lot more easily in the future. Although on paper cash did decrease for the year, if we use our figure at the end of this year, which is this here, and then we add back in the money it costs us to go debt free, which is this figure here, we can see that we would have a cash position of $996 million. And then we deduct it from last year. we can see that we would have generated $95 million in cash. And this is excluding the money they spent on their marketable securities, which is like stocks and bonds. So if we add back in that, we would have generated $211 million in cash for the year 2024. Now, a concern I've seen investors have with Abercrombie at the moment is that their inventory increased 22%, which is a pretty bad sign. Retailers usually build up their inventory in Q3 in preparation for the holidays, and their inventory usually drops back down to moderate levels after the holidays. However, I did do a bit of digging and I found some information in their earnings call by CFO Robert Ball, and we can see here that he highlights that although inventory is up 22%, 6% of this is for expected sales in Q1, and the remaining 16% is the part investors are worried about, which is a build-up of stock from the holidays, increased freight costs, and stock they traditionally sell year-round. Although this isn't favourable, it's a lot better than the 22% which I have seen online and investors have imagined. We will be using Stock Unlock's DCF calculator, and if you would like to use the tools we use to perform our analysis, go down to the description where you can receive 10% off your first year. Moving on to our DCF, I will be using EBITDA as our metric growth rate because, as mentioned earlier, it does show us what the core business is producing, and it does take out non-cash expenses such as depreciation and amortization, and it doesn't include the various capex cycles that the businesses are going through. Although they have a metric growth rate of 24%, I will be putting at 8% as they did give a pretty pessimistic guidance for the year, and because I do want to be quite conservative. Although I do think that over the course of 5 years, this will bounce back. I will be putting shares outstanding at minus 4.5, which is slightly below the 5-year average, but is roughly what they anticipate to do in the next few years. And I will be using a price ratio of 3.8, which is what the stock is at currently, but I do think this is very conservative and will definitely bounce back in the next few years. Now, all this gives us a fair value of $80.93, which is 18.3% below the current market value, and could yield investors 13.7% over the next 5 years. And this is with a very conservative price ratio. If this price ratio even goes up to 4.5, investors could see an average growth rate over the next 5 years of 17.6%. Finally, I do believe that Abercrombie is a good company with great management who are focused on long-term shareholder value. And although their fundamentals may suffer in the short term due to tariffs, I believe that if we are looking over a period of 5 years, I think the stock is looking quite cheap, holds extreme value, and is looking, in my opinion, like a buy in the market today. But that wraps up the video for today. So if you enjoyed, please leave a like and subscribe. It would be much appreciated, and we will be doing a lot more content like this in the future. And if you have any questions or recommendations on what companies we should do next, feel free to leave them down in the comments below.